Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
All right, so Jerome Powell just announced the interest rate decision, and in this video, I have some shocking information to share with you guys that you are going to love. This video is talking about State Street, confirming big money is coming into the industry, not just from the Fed, the Treasury, State Street. Big investors are getting ready, they're gearing up, and you need to be prepared. We're getting into the XRP to the US dollar price chart. We are also talking about how much is the national debt and what are the different measures used from debt held by the public. We're also talking about gross federal debt, debt subject to limit, the debt limit, the amount of money that's going into the economy over the next decade, how that's going to affect the cryptocurrency market, specifically Bitcoin and all altcoins, and then also talking about the Fed Watch tool and when a Fed pivot is coming and how a Fed pivot shouldn't signal the all clear to investors and what this means. This is coming from BlackRock. So this is some powerful information, you guys. If you're going to become the first millionaire in your family tree, comment 777. If you're feeling blessed, comment 777. If you're feeling bullish, let's run it.
In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025.
So with the Federal Reserve deciding to pause on their rate hikes with another rate hike coming, this year and then pushing back the pivot until 2024, maybe 2025, we're going to talk about how that's going to affect the crypto markets in this video. So when we look at inflation right now, they had to raise the effective federal funds rate to bring inflation down. Now, it got down to 3%. Then it started going back up, 3.2, 3.7%. And so that was August. Once September's report comes out, it comes out a month later. And if it's higher, the Fed is for sure going to raise the effective federal funds rate, either their next meeting or the meeting after that. So I would expect a 25 basis point rate hike, but they're not going to be pivoting anytime soon. Now, what I want to discuss is what that pivot's going to mean for the markets. But let's talk about the CME Fed Watch tool, because the next meeting comes in, 41 days, 21 hours. So it comes in a while. And if we look in November, so we look at the end of October, beginning of November 1st, when the meeting is going to hit, 53.4% are expecting 525 to 550, keeping this steady, right? Pausing again. So the rate hike might not come next meeting. 39% are expecting a rate hike of 25 to 50 basis points, whereas 7.2% are expecting, a rate hike even higher than that, 75 to 100 basis points. So we'll either pause or we'll go up by about 25 basis points. And so if we look towards January of 2024, 51% are expecting a pause, 40% are expecting a rate hike, and 8% aren't expecting anything too crazy higher than that. But as you guys can see, there is not expected to be lowering in a pivot in rate hikes until the end of 2024. I keep going through this, until December of 2024. Now that's far off in the future to know, because each meeting is going to adjust this. So when you subscribe to the channel, you'll stay up to date. But this just shows you guys how a pivot on the effective federal funds rate is not coming this year. It's not coming 2024 until the end of 2024, potentially 2025. Now, this is important to know for XRP, for Bitcoin, for the cryptocurrency markets and risk on assets that are correlated, to other risk on assets. And you're looking at the real estate market, you're looking at the stock market, and you want to know how these all affect each other. So I'm going to discuss it. And I'm going to bring this information to you guys so you can make your own educated decision, okay? This is not investing advice. This is not financial advice. I'm bringing you the news. What you choose to do with it is up to you. As always, you're a full-grown, educated cryptocurrency degenerate here. Okay, you can make your own decisions, but history shows, according to BlackRock virtually owns the world, and BlackRock, and you see like these massive companies are big investors in virtually everything out there. They're saying that history shows that monetary tightening negatively impacts growth well after the last interest rate hike, the last one. We're not to the last one yet. So 2022 was about inflation, and more inflation, thankfully. And finally, the October CPI print shows the first signs of slowing inflation, and markets rejoice at the prospect of the Federal Reserve having some leeway to stop aggressive hiking interest rates. Whether the Fed pauses early next year or not, they just pause. So this is an older article, but this shows, how on point they are. So history suggests changes to monetary policy impact the economy with long and variable lags. So investors would be wise to remain, wary in 2023. So the investor sentiment for this year is cautious. It's wary. People aren't diving into the markets this year. This is the accumulation year right now. This is not the bull run year. And I'll explain when the bull run is most likely to come that you need to be prepared for. So BlackRock analyzed 10 hiking cycles since 1950 to assess when monetary tightening has the best and the biggest impact on growth. The conclusion is that it's not unusual for the economy to remain relatively strong through a Fed hiking cycle. And only later, typically the following 2 years, does growth begin to weaken materially when they pivot, after they pivot. So as the chart below shows that you guys can see on this video, and it illustrates personal consumption, non-residential investments. So thinking about that, where you think about business capital expenditures and government spending remained well in the positive territory as the Fed was raising interest rates. Over time, tighter policy accumulates and growth begins to falter, with non-residential business investment and consumption are being the biggest drivers and contributing to a deceleration in GDP. So this makes sense because the whole reason the Fed hikes rates is to slow a booming economy and prevent overheating due to high inflation. And so against this prosperous backdrop, while the Fed is hiking, businesses and consumers tend to feel confident in their spending through credit cards. That's why credit card debt is maxed out and it keeps growing right now. Ultimately, the tighter financial conditions slowly trickle into business decision making and household spending, which often precipitates the pause in hiking. And so the notable exception to this timeline is residential investments. Again, this is logical because the impact of higher Fed funds rates is almost immediately passed on to higher mortgage rates, obviously. That's why real estate, it's a lot more expensive to own a home as interest rates go up, because you're going to have to pay, higher down payment, higher monthly payments for your mortgages, leading to a slowdown even early in the hiking cycle. But the time the Fed pauses, most of the damage has already been done and activity tends to rebound modestly after a period of restraint. Another caveat is net exports, which have on average been positive after the Fed pauses, but this is often due to weakness in imports, which is another manifestation of a decelerating domestic economy. Now, if we look right here, the bottom line that we need to look at is that monetary policy has long and variable lags, and you don't feel the effects right away. You don't see them right now. And case in point is we just got back from Disney and it was packed. There were people stuffing their face with alcohol, food, all sorts of goods, and people are just fat on life like Rome in the late stages before that empire collapsed. People are just stuffing their face with food, still going on vacation, still spending on a credit card. People not really feeling the effects right now. They're still traveling. They're still having fun. They haven't seen the recession or the crash hit yet, and they're just getting on by. So 2023, is likely the year that the long-awaited growth slowdown just starts to tip and starts to turn. And going into 2024, 2025, we could still experience some growth. And I'm going to talk about why in the crypto market, I'm expecting that growth to keep going until 2025, and then the crash to hit after that. And so this year, I do think there'll be a dip, but it's going to be nothing compared to the crash that's going to happen after the peak of this bull run once it ends. And then this crash is going to be absolutely disastrous. So you still have some time, but your time is limited. And when the Fed pivots, how will that translate to positioning that you need to be ready for? What is BlackRock preparing? What are they doing right now? So all of this matters because risk assets, crypto as a risk asset, have staged a strong rally lately. It could be overdone is what they're saying. From their perspective, investors would be wise to think about their investment opportunities set in stages, near-term and long-term opportunities. So amidst what's likely to be a portion of slower growth and market volatility over the coming months and quarters, they like short-term investment-grade bonds that offer the highest yields seen since 2008 and potential resiliency with significant more returns potentially than pure cash, which would put treasuries in that category as well, which is the inverted yield curve, right? Where short-term treasuries are yielding higher than long-term right now. So banks are offering incentives for people to receive like a 5% yield on their money over the course of 90 days if you're setting up bank accounts, whereas like a 10-year longer-term prospects of the economy aren't as, exciting for investors in bonds. And so that's the yield curve inversion, is massive right now. And as shown in this chart right here, since the 1960s, the Fed has repeatedly hiked interest rates to combat inflation. So notably, the stock market continues to perform well when the Fed is lifting interest rates. Each time that increase in the stock market, as the Fed was hiking rates, it led investors to believe that this time was different. However, the Fed paused or pivoted from monetary accommodation as an economic recession or crisis was realized. And so the pivot, comes when we see right here the past Fed pivots that took place. You see the crisis right here in gray. In vertical, you see the 2-year Treasury yield right here, following the Fed funds effective rate, and then you see the S&P 500 in red. Now, one thing that's interesting is the last pivot that took place, after the Fed paused and then lowered the effective federal funds rate, we saw the COVID crisis and a recession hit after that, right? At almost the bottom, right? Almost once they hit the bottom and rates were down to nothing. Before then, the Fed pivot took place, and then we saw the credit crisis, subprime mortgage crash while they were pivoting and lowering rates. So the markets crashed with that. The time before then, the Fed pivoted. Then the dot-com boom happened when they were lowering rates. And so the past 3 times, the recession and the crisis, dot-com, subprime mortgage, COVID hit after they went down, once they went down. So because the Fed, let me know your thoughts, whether you agree. If you agree, give this video a like. If you disagree, let me know your comments below on when you feel this is going to happen, because the Fed is going to keep going up. They might pause next meeting, but they're going to go up another 25 to 50 basis points. They're going to keep going up to keep inflation under control, because inflation went down to 3%. Inflation's coming back up. So they're going to have to keep going up on their effective federal funds rate to combat inflation. Now, because the Fed Watch tool expects there to be a lowering and then a pivot at the end of 2024, maybe even to 2025. If it comes sooner, that will be based on what Jerome Powell says in the next meeting. But so far, end of 2024, 2025. What does that mean? Well, let's look at what it means and what it meant in the past. And so, as you guys can see, the S&P 500 from 2015, from 2009 to 2015, they kept rates relatively low right down here. And then between 2015 and 2018, as they started to raise the rates up, you can see after the EU crisis, the market was rallying. The market rallied up. The time before then, from 2003 to 2006, you can see they were raising the effective federal funds rate. What happened from that? The markets recovered while they raised the rate until the credit crisis, subprime mortgage crash. So the markets rallied while they raised the rates. The time before then, you can see the markets rallied from 1991 all the way to 2000. So for 9 years, when they lowered rates and then they raised them up, paused them, lowered them, it was kind of volatile, a little bit tricky of a time to predict what was going to happen here. But when they pivoted, that's when the market crashed. So right now, we're early in this hiking cycle. And so when they will pivot, might not even be till 2020, end of 2025, 2026. And so when I say you guys are early in this bull run cycle for crypto, I'm going to show you what I feel is going to happen. But this is lagging data. So the recession is lagging. The recession is going to come. It's going to happen, but it's lagging right now. And so such is the case because the Federal Reserve is operating on lagging data like inflation and employment to dictate monetary policy changes. By the time the information comes out and the Fed makes a decision, they're making decisions based on the wake of the boat versus steering the boat ahead, because they kept interest rates so low for a period that they didn't need to keep them at, and that's now affecting the economy. So now they're trying to steer the boat with the wake, which is why we're heading for a massive collapse, because it takes 6 to 9 months for changes to interest rates to work their way through the system. And by then it's too late when the data reflects a policy error. So the Fed is the arson and the firefighter trying to put out their problem that they created. So the chart that you can see on the screen right now of the unemployment rate, recessions, and the federal funds effective funds rate shows the problem. Currently, the Fed, has been hiking rates. Right now, they just paused, as unemployment remains very low. However, the unemployment rate historically sharply reverses upon the realization of an economic recession as the Fed slashes rates and pivots. And so I've said this in previous videos, the unemployment rate is at historic lows right now. The last time that we were at historic lows was right before a collapse, right before a crash, right before 2008, right before COVID, right before 2020. So the past times that the Fed pivoted, when they pivoted, unemployment spiked up, markets crashed, doomsday, everyone thinks the world's falling apart. They run to the grocery store, they buy food. You do not want to wait when that happens. Not if. It's not a matter of if, it's a matter of when. When will people rush to the grocery stores to get food? When there's a shortage in food, when the markets are crashing, people are panicking, they're freaking out. As the Fed is lowering the effective federal funds rate, unemployment is going up, people are losing jobs, and catastrophe is out there. They usher in lockdowns. If they do that, now my thought process, again, I could be wrong here, is when they do that, not if. Like I said, I could be wrong, but history rhymes, right? Fall, winter, spring, summer. Fall, winter, spring, summer. The people that think winter isn't going to happen haven't been around here long enough to realize that winter always comes. Some winters are longer, some winters are shorter, but you have to prepare for winter. 2011 to 2013, the bear market, roughly a year, accumulation. Then the bull market, 2014 to 2017, bear market, roughly a year, accumulation. Then the bull market, 2018, 2021, bear market, roughly a year, accumulation. Then the bull market. 2022 to 2025, bear market, roughly a year. We're still in accumulation. Then the bull market comes. By the end of 2025 is the peak. Could it be that the Fed makes the pivot at the end of the bull run of 2025? They start slashing rates, unemployment goes up, the crypto market's peaked out, then the crypto market crashes, then the stock market crashes, and then that's when we see the recession. That's when we see a 1929 style stock market crash and collapse. And what people were predicting to happen this year for that are just a few years too early, and the crash comes leading into the bear market of 2026. Could that be what happens? It's anyone's guess, but it's very interesting. That'd be some crazy matrix level timing because Bitcoin is still in stage 1, the accumulation stage. So stage 1, accumulation, stage 2, bull market, stage 3, bear market, stage 4, liquidation. Well, if we look at the Bitcoin market cycle right now, we can see it's blue. It's in accumulation stage. After accumulation, what happens? Well, Bitcoin halves, then we go into the bull market. And once the bull market's done, then the bear market hits. It takes about a year to go from top to bottom. Then the liquidation stage hits. So very interesting if we look at the past. It's showing that we're about to go into a bull market come 2024. So after Bitcoin's halving, so right now, it makes the most sense to accumulate as much wealth as you possibly can, to limit your spending, limit your credit card spending, limit your liabilities, and no financial advice, but back up the truck as much as possible and get ready for any other dips that take place as you dollar cost average. So debt held by the public. What are the types of debts and the reason why big money is about to come into the market? Let's talk about this now. So the Federal Reserve is going to respond to inflation. That's what they're doing, to set monetary policy and to set monetary print orders of how much money is going to go out there. Now, this is very important because this shows where this money would come from. So if they keep raising rates and it becomes more expensive to borrow money, well then where would they get this money to come from to put big money into the market, right? That's a good question. So debt held by the public is the amount of U.S. Treasuries borrowed from the outside lenders via financial markets to support government activities. Now, that debt is held by individuals, retail people that want to take out loans, businesses, pensions, mutual funds, state and local governments, and foreign entities. It does not include intra-governmental debt, which is used to track the cash flow of trust funds and other government accounts. And so many economists regard debt held by the public as the most meaningful measure of debt because it focuses on cash raised in financial markets to support government activities. It is often expressed as a percentage of gross domestic product, GDP, a ratio that measures the economy's capacity to support such borrowing. So, debt as a percentage of GDP is particularly useful in comparing debt levels over time and among countries of different sizes. Now, the United States debt to GDP ratio at the close of 2022 was 97%. While this figure is down slightly from 100% in 2020, a 74-year high, the nation's fiscal outlook is still on the unsustainable path. Debt held by the public is on track to exceed GDP in 2024, climbing to 119% in 2033. So, when we look right here, based on what happened in World War II, in dollar terms, debt held by the public at the end of 2022 was $24.3 trillion. Such debt is issued in a range of maturities from 1-month bills to 30-year government bonds. It also includes securities not traded in secondary markets, such as savings bonds and state and local government securities. At the end of January of this year, 2023, domestic creditors held 70% of the outstanding debt held by the public. Foreign creditors held the remaining 30%. Now, the projection by 2033, debt held by the public percentage is going to go up. So the debt is going to rise from roughly $30 trillion to the gross debt to over $50 trillion. So the Federal Reserve typically amounts for a significant proportion of debt held by the public owned by domestic investors. As of December 2022, for example, the Fed owned more than 34% of domestically held public debt. However, in response to the recent spike in inflation, the Federal Reserve is decreasing the amount of Treasury securities they hold. Therefore, the proportion of debt they own may drop, but that's still not going to stop the gross debt from raising over the next decade. So gross federal debt equals debt held by the public plus debt held by the federal trust funds and other government accounts. Now, in fundamental terms, it can be thought of as debt that the government owes to others plus debt that it owes to itself. I know this can kind of get complicated, but gross federal debt stood at $31.3 trillion at the end of January. 6.8 trillion of which represented securities held by government accounts. Of that total, 2.7 trillion is held by Social Securities, old age, and survivors insurance trust fund. Securities held by such accounts represent internal transactions of the government and thus have no direct effect on credit markets. And so, with that $31.3 trillion, the Treasury, Janet Yellen, confirmed that number is going to be over $50 trillion by 2033.
Do you know how much a dollar that you held at the start of the Biden administration in January 2021 is worth today?
Well, we've had inflation and it's declined in its purchasing power.
It's worth 87 cents. In your testimony, you said that inflation is the number one economic problem. Do you know what the inflation rate was at the start of the Biden administration in January 2021?
It was substantially lower.
It was 1.4%. You said that inflation has many causes. I agree with that. By the way, I would say that the number one economic problem is our debt and deficit. And I would say that the top three causes of inflation are massive deficit spending, the war on fossil fuels, which have driven gasoline prices to record levels, obviously supply chain dislocation that was caused by our miserably failed and incredibly stupid response to COVID, the pandemic. But would you agree those are the top three causes of inflation? Deficit spending, high energy costs, and supply dislocations?
I don't believe that deficit spending is one of the main causes of inflation.
I mean, inflation is too many dollars chasing too few goods.
Well,
so when you're printing all this stuff, so do you know in the first 3 fiscal years of the Biden administration, you know how much the total deficit spending is going to be?
We had an economic collapse that was caused by
right,
the
and
pandemic.
we were certainly coming out of that because there's all this pent-up demand and a sloshing around of trillions of dollars. So I'll answer that question for you too. The first 3 fiscal years of this administration, the total deficits would be about $5.7 trillion. So now you're here testifying about the president's budget. How much are the total deficits over that 10-year period according to the president's budget? You don't know that off the top of your head? Yeah, listen, I'm running out. It's $17 trillion, okay?
Yeah, that's,
You're going to drive the debt from somewhere around $32 trillion up to about $50 trillion, correct?
yes, but what I believe is the single most important metric for judging the fiscal stance of the country is real net interest as a share of GDP.
Okay.
We have
so are you
a
concerned
large
when you're taking the
GDP.
debt from $32 to $50 trillion? Are you concerned who's going to buy that debt? And also at what rate they'll expect to be compensated for buying riskier and riskier debt? Are you concerned about that?
Well, if the real net interest cost of the debt remains low relative to GDP, and we're on a sustainable fiscal.
Well, we're not on a
Well,
sustainable path.
I would
Senator
disagree with
Senator Cassidy was talking about the president's demagoguery on Social Security, unwillingness to meet to try and save Social Security. If we do nothing, and the Social Security Trust Fund runs out 2023 to 2025, about the end of the budget period, are you concerned about, are we going to have the financial wherewithal to plus up benefits to honor those promises? I mean, you think we're going to, with $50 trillion in debt, a debt's exceeding our GDP, aren't you concerned about our inability to honor those promises?
The interest cost on the debt as a share of our economy remains quite low throughout the 10-year horizon of the president's budget. It remains around 1%.
Secretary, and you're also the one who said that
very manageable.
You also said that inflation was transitory, and it certainly isn't. And I think Chairman Powell certainly now agrees the fact that, no, we've got something going on here that's going to take a very long while, unfortunately, to wring out of our system. Not only you, but OMB Director Young and members of the other side keep talking about that you're cutting deficits. The deficit in 2021 obviously was high because of the pandemic, but in 2022 is about 1.4 trillion. 2023, we think it's going to be about 1.6 trillion. 2024, you're projecting 1.85 trillion, and again, growing debt by another 7. It never drops below 1.5 trillion dollars. How can you claim that you're cutting deficits?
So that brings me to debt subject to limit. The debt ceiling, also known as the debt limit, is the maximum amount of money that the U.S. Treasury can borrow. So increasing the debt ceiling allows the Treasury to borrow funds to pay for government obligations that have already been incurred due to laws and budget approved by the President of the Congress. So debt subject to limit is almost an identical measure to gross federal debt. The main difference between the two measures is that debt subject to limit includes debt issued by agencies other than the Treasury and the Federal Financing Bank. The debt ceiling has been suspended until January 1st of 2025, meaning that they have no limit. They can keep printing more. They can keep issuing more money, more bonds, whatever they need to do to pay their bills and to put more money into the economy. So each measure of debt is useful in understanding the nation's fiscal condition. However, no matter the measurement, the debt is headed towards historic highs. And at some point, the cards will collapse. And right now, the policymakers, the Federal Reserve, they're addressing the country's unsustainable national debt by raising the effective federal funds rate. Currently a pause, they're going to keep raising it up. And then once they pivot and they start lowering rates, get ready for chaos to ensue. So until that happens, by 2033, if we're going, my question for you is this, as we figure this out together here on the Bull Runners channel. So if we're going to go from $30 trillion to over $50 trillion by 2033, and if the Fed keeps raising the effective federal funds rate, based on the data that I just shown you, how even when the Fed raises the rates, the markets have grown because they've still put more money into the economy and the gross debt continues to rise. What's more important? Is it what the Fed decides to do, or is it the gross debt is the debt growing more important than the Fed's decisions right now to raise? Because clearly the past 3 times that the Fed's pivot leading up to the pivot, the stock market has grown while they've been raising the effective federal funds rate. Crypto has grown while they've been raising the effective federal funds rate. And so gross debt, $20 trillion by 2033. How do you think that's going to affect XRP? I think it's bullish. Right now, accumulation, could we go lower? Absolutely. We could come back down to 32 cents, 28 cents one more time. But by the end of 2025, that money has to flow somewhere. And right now, the institutions, BlackRock, Fidelity, you see all these massive companies applying for their spot Bitcoin ETFs. If those get approved, mass institutional money is going to flow from the stock market, mutual funds. You have all these old school styles of investments to come into the cryptocurrency market. And could it be compared to right here, where we saw this last final sell-off for XRP from October of 2016 down to February of 2017, before we saw XRP rally out of that over 7,500% and ultimately, over 60,000%, going upwards of $3 from 0.005. Does that mean that XRP will see the same percentage growth? Not necessarily. I've seen a lot of crazy price predictions. I know I've made some videos throwing those in there. That doesn't mean that I'm saying them. I'm just showing you guys what other people are saying. Then I'm giving you a realistic price projection. But if we were to draw based on the Fibonacci retracement tool from the all-time high to the low of March of 2020, and let's just base this off a full extension, that would put XRP at around $13. $13. So is it possible for XRP to go from where we are right now, 51 cents, to $13, doing it at 2,400, almost a 2,500%, a 25x from here, based on 30 trillion gross debt to 50 trillion gross debt, $20 trillion going where? Spot Bitcoin ETFs. Liquidity in Bitcoin affects liquidity in Ethereum, affects liquidity in XRP, affects liquidity in the rest of the markets. I think the answer is obvious.
So it's clear that this market needs to come from the big players, and I think that especially here in this audience, people that have been working on it for several years have been a little bit, okay, why is it so slow? And I think that the point where we're here today is different from where we were a year ago. At this point, correct me if I'm wrong, you guys and your peers are coming in a big way. It's just happening at the pace that it's coming, and to make regulators comfortable with it.
I think that's right, and I think it's accelerating for sure.
So as you all heard from that video intro, the representative from State Street confirming that the big players are coming. Ladies and gentlemen, I'm showing you all synchronicity and key vocabulary. Do you all remember the CyberX researchers found back on September 11, 2023, the London Stock Exchange Group went on to say, head of capital markets at the LSEG earlier today told Financial Times the London-based exchange had been examining the potential for blockchain-powered trading venues for around a year and had reached an inflection point. I've shown you all multiple times in the past that these elites use the same vocabulary across the board. Listen to this representative from JP Morgan mention the same exact terminology, and listen to this representative from Goldman Sachs say the same exact thing. They mentioned the terminology inflection point.
Investors realize that actually digital bonds are cheaper than regular bonds, and they kind of go, actually, I'd like to buy more of those, less of these. How do we get? And then you start to get the inflection point where that market develops. And
I think one thing that's everybody knows about Goldman Sachs is that you're really good at timing the market. And in this specific market, it looks like you're quite early. And do you think you're quite early? Is it now the right time to deploy? Where do you see the horizon? What is the timeline that you see realistically for an institution such as Goldman Sachs to be able to be, in production with a tokenization solution?
Yeah, interesting. I'm hoping we're not too early. I would say, actually, I feel we're at this inflection point. So.
Ladies and gentlemen, this video breakdown is only from August 10th, has 35 freaking views. This video is only from a month ago and has 126 views. This is physical proof that nobody is tapped into this information. However, now you watching the CyberX platforms, you all know that these big institutions are for a fact coming. They're openly telling you all this in their panel discussions that nobody is watching.
So based on this information, we're backing up our truck all the way, the bank grabbing the bags, packing them and stacking them, leaving no bags left behind because the spending power of the dollar continues to go down in value based on inflation. That's a fact. Blockchain technology is going up in interest. That's the truth. And together, we're all going camping on the beaches of the moon. I will see you on the next video. If you want to learn our #1 way to earn passive income online without any crypto trading experience, then make sure you're subscribed to our video newsletter on bullrunners.com. All you have to do is click the button on the page, put in your name, your best email address, and your phone number if you want to receive daily updates and information, time-sensitive information and videos like this, and just click the button. You'll be subscribed, and you'll stay up to date on what's going on right now because we give you the best so you can prepare for the worst that's coming in the economy. I will see you on the next video. I will see you on bullrunners.com. As always, you know what to do. Stay bullish.